I can see the live button there, 55, 1 minute. Hello and welcome to our brand new show, Daily Finance News. This, of course, is your one-stop shop for all personal finance related news. I'm Mubina Kapasi and we have lots lined up for you on today's edition of the show, so stay tuned. But as always, we start the show with the top stories of the day. Stories that directly impact your money, the way you invest, the way you budget, the way you save. So let's kickstart our show with just that. And I promise you, we've got lots lined up right after. Well, first up, starting the 1st of October, that's tomorrow, we're going to have a whole host of Budget 2024 related changes that will become applicable. Finance Minister Nirmala Sitharaman had introduced some of these changes in the July budget. So here's what's going to be applicable for some of you. First is the Vivad se Vishwas scheme. Now, as you know, that a couple of years ago, the FM had introduced this amicable platform wherein taxpayers and, of course, the department can come together and resolve certain tax disputes. Now, this scheme is applicable for the disputes that are pending as on the 22nd of July, 2024. So if taxpayers have an ongoing issue that's related to tax, interest, penalty, fees, etc., that is right now in front of any appellate tribunal, High Court, or even the Supreme Court, then you can take part in this scheme. You need to settle your dues between the 1st of October of 2024, that's tomorrow, and the 31st of December 2024. So you either need to pay the full disputed tax amount or you pay up 25% of the disputed interest, penalty, or fee. That's rule number one. The second change that has come in is with respect to the securities transaction tax. Much to the dismay of some of our futures and options traders, now the STT on futures and options has been hiked. So the tax rates will increase to 0.02% for futures and 0.1% for options. Do remember that you have to pay STT for any transaction you undertake on the exchanges. This is for cash trading and investments, and even for futures and options. So for derivative traders, this is a bit of a blow. A TDS rate of 10% will now be applicable to central and state government bonds, including floating rate bonds from the 1st of October. However, if your income for the year is under 10,000 rupees, then you will not be subject to this TDS. If your annual income is more than 10,000 rupees, then you will have to pay this 10% TDS rate. But on the other hand, there's some bit of good news for certain individuals. If you come under the sections of 19DA, 194H, 194IB, and 194M, then the TDS rate that is applicable to you, as many of you may know, was 5%. Now, from tomorrow, you will be subject to a TDS of only 2%. So a bit of a relief over there. If you are an investor, then chances are that you have seen share buybacks. That's essentially when the company buys back the share from you. Now, there will be a tax on that the investor will have to pay, similar to how it works with dividend. So essentially, the tax responsibility has shifted from companies to shareholders. This, in fact, could also have a big effect on buyback strategies from here on. So these are all the changes that the finance minister had brought about in budget of July 2024, and that's something that's going to be applicable from the 1st of October 2024. Now, there's a very interesting new SEBI rule as well that will be applicable from tomorrow onwards. If you'll remember, a couple of weeks ago, the market regulator had ordered market infrastructure institutions, or as they are called, MIIs. Now, what do MIIs include? This is your stock exchanges, clearing corporations, and depositories, to stop using slab-wise fee structures. What will happen now is a more uniform fee structure. Now, as an investor, of course, you must be wondering, what does this mean for you? Essentially, it is now meaning that there will be a more transparent structure and lower transaction costs for customers as well. Remember that under the current system, these exchanges charged broker transaction fees based on their trading volumes, and they used a tier system. These fees were collected monthly. But now this is something that will benefit investors because the overall costs may go down, and this is something that may be transferred on to investors as well. And in news from today, in a board meeting, SEBI has reduced the timeline for the listing of public debt securities from 6 days to 3 days. Good news for those who are raising the money, as well as, of course, for investors in such debt securities as well. This is not mandatory. The new timeline will be optional for the first year, but after the first year, it will become mandatory. And finally, for all the chartered accountants out there, or for those individuals who are subject to tax audit, there's a bit of a breather because the Central Board of Direct Taxes has extended the deadline for submitting the tax audit reports. Remember, the deadline falls today. That's the 30th of September, but now that has been extended to the 7th of October. The extension is because there have been certain challenges that taxpayers have faced while electronically filing their tax audit reports. Many reported problems with the e-filing portal, which was evidently slow and made it hard to upload reports on time. So the new tax audit deadline is now the 7th of October. Well, that's all the changes that come into effect from the 1st of October. And many of you may be subject to these. Many of you may see a direct impact on your money because of these changes. So right here in the Daily Finance News, we'll be getting you such stories that have a direct impact on you, your budgets, your investments, your money. Well, the 30th of September means it's the end of half of the financial year. This means that it is a good time to give your money, your budgets, your investments a review. This is a good time to conduct what we call a half-yearly financial checklist. Check if your tax planning has been done properly. Review all your investments. What has changed in your financial situation? And are you meeting your budgets? This is all that we'll be discussing today on the show. And ladies and gentlemen, don't forget, if you have any questions or queries, we'll be right here to get them answered. So keep commenting on the YouTube channel right here on the links below and the comment box below, and we'll get those questions answered. So to do all of this, today, I'm joined by Vivek Rege, the founder and CEO of VR Wealth Advisors Private Limited, the SEBI registered investment advisor. Hi, Vivek. Many thanks for joining in. And I'd like to start off from the point of view that many of us don't really look back on our financial year and look at how we've done between April and September. So from a finance perspective, is this something you recommend? And, do you think that everybody should really be looking back at their finances, seeing what went wrong, what they did well, and sort of creating a checklist of sorts?
And good evening, everyone, as well. So, see, for everything, what I feel, and I think this has always been my experience. You need a bell to ring, to do something. Okay, and I think you need a date for it. So, whether it's a birth date or a wedding anniversary, or you need some date, right? Because we tend to keep that in mind. So, I think from a structure point of view, it always helps to have one date. And I think once you come at the end of the half year, which is the 30th of September, it is always a good way to kind of sit back and over the weekend, it is not 30th September, but over the weekend, coming weekend, you can actually take a stock of things. Okay, which gives you a sense of what you have done in the last 6 months. And I'll tell you why it is important, because it is not only the investment part which is important. Okay, it is also important to capture your own thoughts and reflections of what you have been doing. Okay, and once you reflect, you try to highlight certain things, or things which have really gone in what you thought, and some things would have actually gone way differently from what you thought. Okay, and I feel that when you sit around this half year, you try and bring all of this together. Okay, so something very important is to, of course, start with your investment plan, because finally you want to rewire or retire wealthy. Okay, and for that you need to start looking at it in baby steps, and 6 months is a good step to kind of review and look at it, and then see whether things are going in that order or not. You may be surprised to know that sometimes you might find certain elements which probably needs a relook. And once you fix those elements, you still go much ahead in terms of saving and investing that. Okay, so of course you start with your investment plan. You ideally do it around the March end, for the next financial year. And I think that is one piece which you always want to review once you come in the half year mark. You also take a stock of the forthcoming spending goals, because as you know, after September it is a lot of festive seasons which start, and often these expenses are not the routine expenses. They could be expenses which are like chunky expenses, which might take a bit of your liquidity out of your bank system. Okay, and there is a social culture, a social responsibility which we have to do based on the family, based on what narrative we have given to them. And I think it's very important to also do one quick liquidity check, because you are entering a festive season, and therefore it might happen that you might end up spending more than what you have, which also means you might need to do it on your credit card. And therefore it is very critical that you have one check, so that you don't end up overdoing it while the festive season is all on, which I call checking your liquidity profile. And also it avoids you to borrow less, in just in case you end up doing that. Mostly we don't encourage you to do that, right? Also checking your overcommitment, if you have done in the last 6 months, anywhere you kind of taken some subscriptions, something which is kind of overcommitting, because you commit on different points of time, and when you look back you realize that, oh, I didn't even realize that I have kind of overcommitted my budget in some way. So it is very good to kind of look into your subscriptions, what you have done, whether this was really planned when you ended when you started the budgeting around March end. Also important to take a stock of your risk management in terms of the life cover, because the income would have increased. Okay, you might not have seen your life cover uh, review done. So it is very important to kind of do that also once while you are young. Very good if you do it regularly. Also from a health cover point of view, if you are able to do it, it will be a very, very healthy practice if you are looking at it every 6 monthly and just seeing whether there is any requirement. Okay, because there could be an addition in the family, or some more obligations are taken while the life cover is still the same. So I think it's very important to kind of have that kind of rounded checkpoints done at a half yearly basis.
You mentioned a very important point that I think most of us tend to neglect, and that is those subscriptions bit. Because as you were speaking, honestly, even I was running them through my mind, that what are those subscriptions that I have that I need to cancel out or that I'm not using. So that's a very valid point. Let's talk about the bit with respect to expenses, especially now that we have the festive season coming up. So most of us may tend to splurge a bit more. Is there any thumb rule that all of us can sort of look at to know whether we have exceeded our budget or we are still well within our means? Because it's very difficult to do that. If you have X salary, how much really is called as being under budget or within your budgets? And to what extent would you say that, okay, now you're being a little careless and maybe it's time to step back?
That's a great question, Mubina. So I will bucket this into two parts. One is people who have regular income flow and people who may not have a regular income flow. So in case of if you have a regular income flow, I think the best thing to do is if you can follow a rule, which is a simple rule, which is known as a 50-30-20 rule. What does that mean? Out of the total amount, right, you first save the 20%. Okay, it is very important to start committing something towards saving, which is 20% of what you get as your credit in your account. Because the minute you do it, there is no way that will be spent. So you start the reverse. You start saving, earmarking, okay, how much of that amount will be 20%, and start committing it on a monthly basis on which you don't have absolutely any control. Let it be saved, because then what remains is that 80%, right? In that 80% you have a lot of choice, because out of that 50% will be your needs, okay, and 30% will be wants. And believe me, the minute you start doing it, you'll be more mindful about what you are asking, okay, and also mindful about the fact whether this is a need or a want. Okay, at points of time, these are discretionary spends. So want typically comes under the discretionary spends. At some point of time, if you are mindful, you might end up saving more also, because that amount of money will still be available to you. Okay, needs are something which we have to meet over a period of time. These have your groceries, your rentals, your electricity bill, your Tata Sky connections, your subscriptions, your gym fees, all of that. But your EMIs, all of that should cover somewhere in the 50%. 30% is something which is wants, okay? That what kind of lifestyle you want to lead, what kind of hoteling you do, what kind of purchases you do, etc. So I think these are very important. So if you start with the saving piece first, at least commit 20%. Okay. Then the 30% is something on which you will be much more mindful when you do it. The minute you get into that habit, I can fairly guarantee you, based on my experiences, that you get into doing it more and more, right? It's a habit in which you get in more. If the habit is spending, you will get into a habit of spending more and more, and there is no limit to it. Reversely, if you are getting into a habit of saving, you try to overdo it a little bit. So we have seen cases where people try to save more than what they have committed, and that's because they get into a habit. I think getting into that habit is very, very important. So I will ask you to follow that thumb rule. However, if you don't have a regular income, irregular income, because let's say you have a certain income coming, but a chunk of income coming through bonus, let's say variable pay. At that point of time, also, it is very important to be conscious about the cyclicality in your occupation. Because of the occupation, you're getting the cash flow. So if you are able to see it from that angle, and then be very prepared that, okay, from the amount what you are getting, let's say that I'm going to get my bonus in the month of March, and if that is going to be the chunky amount, it is very important to start pre-planning, that how you will, kind of uh, push it into different buckets so that you are able to exactly follow that rule of 20% of saving, 30% of wants, and then you have a luxury to decide how to do it. So just follow this. It's a very simple mechanism, but it's very, very effective.
I think the one point that you mentioned towards the end as well is that also when you get any windfalls, bonuses, or something like that, it's important to also plan in advance as to how you will spend that money. Otherwise, you may end up spending it on something very, frivolous. Anyway, that's the savings part, the budgeting part. But there's also the investments bit. I'm hoping that most of our viewers here have made some investments or the other in some way. But where are those investments? How are they performing? Are they serving your goals? That is something that may be a bit of a question mark. So, Vivek, this half yearly checklist should also include investment reviews. Could you tell our viewers what's a good guide that they should look at when they are seeing whether their portfolio is still suiting their needs?
Yeah, sure. I think as we come from, this 50-30-20, model, and we come to that 20% of the saving, which then moves into an investment, and an investment portfolio gets built over a period of time. The best thing to do, and I think one of the things we should always remember, is do your risk profiling. Okay, your investment will only do well when you are very clear about what risk you can take and what risk you cannot take. Number one. Number two is that when you complete your risk profiling, and there are a lot of tools which are available, it will give you a allocation in terms of how much of equity, how much of debt, how much of cash you need to kind of keep. Let's call it a strategic asset allocation. Now, that is an asset allocation on which you start building your portfolio. Okay, that's your plan on which you start building your portfolio. Over a period of time, you'll realize is that based on the market forces, the portfolio drifts, right? It will drift in some way or the other. Very rarely, it will be exactly the same as your strategic asset allocation. And the drifting tolerance level should be about 5%. So, for example, if I say my equity is 50, then I can allow it to drift up to 55%. Because the minute you start allow it to drift more than that, the behavior of the portfolio undergoes a change. Okay, because it will have its own character when you move it from, let's say, 50 to 60 or 60 to 70, and it drifts because the market forces might take the portfolio in a certain way. So when you start something, you start with a strategic asset allocation, keep that as your foundation, keep looking at it every 6 months whether it has drifted. It would have drifted either ways, meaning that the equity would have really done well, so it would have gone up, or the equity may not have done well and it would have gone down. At that point of time, your cash position will be able to meet the requirement of rebalancing it, and so you get back to the 50-50. I think by doing this, principally, you remove the emotions out of it. You don't look at the market and say, hey, look, I mean, this is looking very attractive meaning it is going up, therefore it is attractive, therefore I want to keep putting more and more money into it. If emotions come into picture, it becomes a portfolio which is built on emotions and it is not built on certain fundamental principles. And that's where I think people do the most investment mistakes happen at that point of time, right? So it's very important to keep very strict control on the strategic asset allocation. Also, while you are doing it, please remember to check the taxation aspect, because at some points of time you don't want to end up taking suboptimal decisions, right? And why I say that is that because there are certain gains which happen on long term, certain gains which happen on short term, and the taxation are very different in both of these. And therefore, it is important that when you are rebalancing, just be very mindful about it, that what point you are touching the portfolio and what is the tax implication. Don't worry about the tax implication. However, my point is that it should not be suboptimal. Okay, and I think this is very important. Also map it to the goals, because our investment portfolio without any goals don't mean anything. There has to be some meaning to the money. Therefore, if you are building it for a certain goal, you will have a time horizon, and based on the time horizon, you will be able to exactly know, that how much, uh, the risk profile should help you to set up your allocation, and then keep putting that 20% which I've told you. Okay, and whether that is exactly going in the same format or not, if you take a half yearly checkpoint, it will give you a lot of insights into how you really disciplinarize the whole investment process and follow it in a diligent way. Okay, and my experience has been, if you do it, okay, it gives you a lot of satisfaction when you look back, because there is a, a, a a steady building of the portfolio which happens, and then emotions don't come in. You are actually building in some principle based on your asset allocation, which helps you to kind of put things in place.
All right. So there's risks. There is checking whether your strategic asset allocation has not, or rather, your investments in general have not drifted too much, more than maybe 5% odd. And then, of course, your goals, very important. And finally, of course, short term and long term capital gains. But speaking of LTCG and STCG, taxation is also an equally important element. But
Yes.
you know what? I want to also take on board some viewer questions and queries that we've received. Remember, folks, you can comment right here on this video, and we will be there with our personal finance experts to get your questions answered. Now, we've got a very interesting question, which, Vivek, I'm sure you must be getting from a lot of. From a lot of your own clients and maybe from people who you may be meeting. Abhishek says that he has just received a bonus. Now he wants to know whether he should invest this bonus or he should repay his home loan.
Yeah, I think very often these questions come, and I think a simple answer to it is, uh, when you look at your net worth, right? Your net worth will have two components, which is your own fund and a loan fund, right? What you have borrowed essentially. Okay, while you are looking at it, and when you have an eye on your cash flow, you'll also realize is that there is a certain amount which you are repaying for that particular, loan, which is also consuming a certain percentage of your cash flow. As long as the answer is that it is not consuming a significant portion of your cash flow, and let me give you a percentage. 30% of your cash flow out of your 100 rupees, if it is going into repaying of loan through EMIs, okay, I think it is a healthy sign. Anything above 30% is something which I believe is that it is crowding too much into your cash flow, which means if you have your needs, it is very difficult to fulfill your needs, and wants will be still more difficult because you have overcommitted something, okay, and which is consuming majority of your cash flow. I think if that is so, it is very important to first ensure that you bring down your EMI to a point by prepaying the loan as much as possible through the bonuses, because that way you will be able to have a very healthy mix of your cash flow, which will allow you to do that 50-30-20 rule and build your portfolio in a steady manner. The another logic for it is that, remember, when you borrow a loan, there is an interest which is fixed. And when I say fixed, meaning I'm not talking about a floating or a fixed interest. I'm essentially talking about a commitment. It's a fixed commitment which we have to keep paying. And the minute that comes into picture, okay, you are committed to pay that amount on a continuous basis. Let's say it is 8.5%. Okay, so 8.5% is given. It is not going to change unless the interest rate changes. However, when you go to invest, there is nothing fixed, right? It varies, right? It is market linked return, and therefore, at some points of time, you'll realize that your returns are 12%, they are 15%, they are 6%, they are 2%, they are minus 4%. So therefore, nothing is fixed, right? Everything is market linked. And it also depends on what kind of strategic asset allocation and your current asset allocation is. And therefore, it is very important that you maintain that healthy mix, okay, so that your cash flow has enough room to save, which can only come when you have lesser EMI, and which can only come when you are prepaying a loan through this windfall gain, which you call as a bonus, which has come to you, and that allows you to be debt free soon. Okay, and being debt free soon means, in other words, you are also building your net worth. So it's very important to keep that in mind, that if you are able to answer this when you do your cash flow, it will give you a sense of what exactly you should do.
Okay. I think you've given that good guideline that look, try not to let your EMIs exceed 30% of your cash flow. This makes it very simple whenever it's put down in numbers, because you just have to crunch in 30% and see how it flows, and accordingly you can make a decision. More tax related questions actually. We have Anil asking us that I have a CTC of 12 lakh rupees. Which tax regime should I choose? Another question, I guess, that all of us have been sort of looking up the internet for answers for.
Yeah, so I think one of the things which you should always look at is that what kind of deductions or tax deductions you take, right? So it's very much a function of the tax deductions what you take under, let's say, under Section ATC, under HRA, under LTC, under Section 24(1), which is the interest on your housing loan, all of that together. Now, if that is around 1.5 lakhs per annum, right? The new regime is better typically, because your deductions are not so much, and it is much better to kind of opt for a new regime. You might end up saving more tax there. Okay. If your deductions are somewhere more than 3,75,000, we feel old regime is much better. Okay, because you still have something which you had from the previous decisions, and it still continues, and therefore it is better to look at the calculation. However, we feel that if it is more than 3,75,000, it is good to have a old tax regime. Okay, but anywhere between the two, okay, it will depend on your income level also. However, if it is uh, 12 lakhs, we feel that you should still look at, and if you have deductions hovering around closer to 1.5 lakh, you should still look at a new tax regime. That is much simpler, much cleaner in that way, and you are not too much burdened with all these obligations which you keep doing just to take a tax benefit. Okay, I think from that angle, if you look at it, it will be much better if you look at new tax regime. However, from your question, I cannot make out what deductions you make, but and therefore, I have just given you three slabs which help you to decide which slab you come into.
All right. Okay. We have time for one more question, and this one is coming in from Aswati. She's asking, well, a very interesting one, that considering the market valuation is very high, does it still make sense to invest in ELSS mutual funds? Vivek?
That's a great question. I think ELSS uh, was a category which was launched at a time where tax benefits under Section ATC was the only thing which people could take and save tax out of the other crowded things which are in ATC. Okay, so therefore I think your tax decisions and investment decisions need not be mixed. So therefore, if you, and you're right, today I think we are at a point where the valuations are at a premium. They are very rich. Okay, and therefore, for tax saving, if you are going to do an kind of an ELSS, my suggestion is that you relook at your overall plan. First, see if it is really required to you based on your income levels and your deductions, whether ELSS is really required, and you can actually move to a new tax regime where ELSS is not required. And you can do the investment the way your asset allocation prescribes you to do, rather than being forced into equity, okay, at this point of time, just because you are getting a tax benefit. In my view, does not make any sense. So therefore, I think you take a very holistic view. The question to ask is that whether you will get much more benefit from a new tax regime. If that is so, then it is very good to actually look from that point of view, and then do your investment based on your strategic asset allocation, rather than being forced into something like an ELSS, which is 100% equity.
All right. Well, I think sometimes, of course, it does help if the viewers do share a holistic picture of their investment portfolio and what they already have, or if they are starting from scratch, because this is something that helps the experts as well accordingly guide you and help you take the
Yeah.
right decision.
Yeah. So one more point I want to add, Mobina, is that there is a narrative with everyone that I have to save tax, and by doing some investment I will save tax. So I don't think people have woken up to the fact that there is a new tax regime. Okay, you can actually look into that. That narrative is playing around that, okay, for tax saving I have to do some tax, some investment I have to do. And I don't think people are well aware about the new tax regime, but I'm sure with your shows you will will kind of educate them, and they'll kind of wake up to this new tax regime, which might help them as well.
Well, that's the objective really behind daily finance news. And, Vivek, that's the reason why I did not ask you about taxes in the financial year checklist, because, like you said, the new tax regime has, I guess, simplified things a lot. And,
Yeah.
it really gives that option to everybody watching that, hey, listen, if you don't want to make the tax saving investments and, have the entire administration that's required behind monitoring them, just pick the new regime and, you're essentially good to go. Okay, well, I think that brings us to the end of our conversation. Vivek, it was lovely having you with us. Thank you so much once again for joining us.
Thank you, Mobin. Thanks. It was a pleasure. Thank you, everyone watching the show. Thanks a lot. Bye.
All right. Well, words of wisdom coming in from Vivek Rege. Remember that it is the 30th of September and it is really a good time to check in on whether your finances are in order. Are you meeting your budgets? Are your investments still suited for your requirements and your goals? Vivek, of course, gave you a rough guideline as to how to go about it. And really, it doesn't need to be the 30th of September. It can be any date, and it could be quarterly. It could even be your anniversary. But please make sure that you are reviewing your finances, your investments, and your budgets. Let me tell all of our viewers that we'll be back with yet another show on Personal Finance TV tomorrow at 6 p.m. If you'd like to ask our personal finance experts any questions, any queries with respect to your investments, your portfolio, comment on the box below and we will get it answered. For now, we're at the end of the show. Thank you so much, viewers, for watching. Have a lovely evening.